Welcome back. In this second part on the introduction to derivative markets and instruments, we shall learn the concept of arbitrage, which is the basis of pricing derivatives. We shall also discuss some of the purposes and benefits of derivative markets and also some of the controversies surrounding them. Let's get started. Arbitrage is based on the law of one price. This law states that two securities or portfolios that have identical cash flows in the future, regardless of future events, should have the same price. Now, imagine if you have a situation where X and Y are traded at different prices. X is traded at $5, while Y is traded at $4. This is an arbitrage opportunity. An arbitrageur could sell X for $5 and use the proceeds to buy Y for $4. This gives the arbitrageur an immediate profit of $1, and the payoffs on Y will satisfy the future liability of being short on X. However, the combined actions of arbitrageurs bring about a convergence of prices. As more arbitrage trades are being made to sell X and buy Y, the price of X will fall and the price of Y will rise. This continues until they are brought to the same price, where the arbitrage opportunity ceases. This leads us back to the law of one price. Note that this price is in no way the fundamental value of the securities. It's based on relative valuation methodology, which tells us the correct price of one asset or derivative relative to another asset or derivative. Arbitrage can also arise when the future payoff differs, even though the securities have the same risk involved. Imagine there's a risk-free bond which is traded at a yield of 4%, while the current risk-free rate is 3%. An arbitrageur can borrow at the risk-free rate to buy this risk-free bond. In the future, the yield of 4% is more than sufficient to cover the interest payments of 3%, and the arbitrageur pockets the 1% yield in the future. Likewise, if this is a true arbitrage opportunity, it'll not last, as buyers rush in to buy the bond, pushing its yield down to the risk-free rate of 3%. So why are we discussing arbitrage under the topic of derivatives? Arbitrage is the basis of pricing derivatives. In the following lessons on the concepts of derivative pricing, we'll use the principle of arbitrage as a dominant theme and assume that arbitrage opportunities cannot exist for any significant length of time for an investor to consistently capture them. As such, prices must conform to models that assume no arbitrage. Still a little confused? Don't worry, we'll discuss more about arbitrage in a later lesson. Let's proceed with a discussion on the benefits that derivative markets bring to the financial markets, and also some of the criticisms levelled against them. To do so, let's begin with a lesson on how the derivative market started. In the past, seasonal produce like wheat and corn markets experienced wild fluctuations in the supply of the commodity. As such, the prices of the commodity also experienced wild swings, leading to a lot of inefficiencies. The introduction of forward contracts allows the producers and consumers to agree on prices in advance. This has led to a reduction in the volatility of the prices due to seasonality. Eventually, people started trading such contracts, and the derivatives market started from there. Derivatives markets today are much bigger, much more organized, and have evolved into serving several other useful purposes in modern finance. We've discussed earlier on the example of a transport company hedging against future increases in oil price by buying oil futures. This is an example of risk management. We know that fuel costs are a large part of a transport company's operating expenses, and that exposes the company to a huge risk if oil prices soar. Instead of buying barrels of petrol to hedge the risk, the company simply enters into oil futures contracts to hedge the risk. This is an example of the operational efficiency. Firstly, the company conserves cash as it only needs to fork out a portion of the cost for the futures margin requirements. The transaction costs in dealing with futures can be much lower than the transaction cost to buy transport, and store the physical barrels of oil. One other extremely valuable operational advantage of the derivative markets is the ease with which one can go short. Take an oil producer, for example. The oil producer may be concerned about the risks of falling oil prices in the future. To hedge against such risks, the producer can go short on oil futures to lock in current prices. Besides the operational advantages, these three features, lower capital requirements, lower transaction costs, and easier short selling, also help promote market efficiency. When prices deviate from fundamental values, derivative markets offer less costly and more accessible ways to exploit the mispricing. It's likely that the fundamental value will be reflected in the derivatives markets before it is restored in the underlying market. Although this time difference could be only a matter of minutes, this can be a valuable opportunity for a trader seeking abnormal returns. Another benefit of the futures market is price discovery. Imagine you have a bar of gold you want to sell to a dealer. How do you and the dealer determine what a fair price is to trade at? Probably the place to look is at the gold futures contract expiring soonest. Without a futures market for gold, gold may be trading in several less efficient and less price transparent decentralized locations around the world. Derivatives, however, are not perfect instruments. They have their fair share of controversies. One common criticism of derivatives is that they are too risky, especially to investors with limited knowledge of such complex instruments. Also, because of the high leverage involved, the stakes involved are high. This has given rise to the perception that trading in derivatives is like gambling. Some take the gambling argument even further, claiming that it has destabilizing consequences. Opponents of derivatives claim that the very benefits, like low cost, low capital requirements, and ease of going short, result in an excessive amount of speculative trading. This can bring instability to the market. Defaults by speculators can then lead to defaults by their creditors, and the resultant instability can spread throughout the markets and economy. And that concludes this topic on derivative markets and instruments. Do note that this topic is introductory material, so certain concepts may only have been briefly mentioned. The next topic will build on these concepts, particularly to explain how prices of derivatives are determined. See you at the next topic.